YouTube, what's going on? Welcome back, Marathon Freedom Investors. This is week 13. Thank you. All right, look, real quick, let me throw this out there. I am not a financial advisor. What I'm doing on my channel is strictly my journey. I'm coming on here every week and I'm going to tell you what I'm doing, right? And what I want you to do is come on YouTube, watch what I'm doing. Remember, YouTube is for entertaining purposes. So if I'm putting money in the market and I do bad, take everything I'm doing that was bad and apply it to your life and say, hey, I'm not going to do that. But if what I'm doing makes sense and you say, hey, that was smart, apply it to your life or apply it to your strategy, right? So welcome back. Week 13. Let's get to it. All right. I'm going to be everywhere. So the information I'm putting out there is my opinion. It's just me theoretically speaking on what I think about the market. It's not 100% true. I'm just giving out a theory. But if you're interested in more theories, there's multiple channels out there with people talking about the market. All right. All right. So this is rhetorical, but why is the market down? Right? The picture in front of us gives a wide understanding of why the market's down. Oil ships are not moving in and out like normal, right? Because a lot of ships don't want to take the risk of damaging their ship cargo, trying to get in and out because of some missile strikes that Iran's doing. Um, so, does America get oil from Iran? No, from my understanding. And if we do, it's a small bit. But the global price is affecting the global. And that's why the prices went from 60 a barrel to 120. And I think now it's stabilizing around like $100 a barrel, right? It's so bad that China has immediately banned on March fuel exports. That's what the sources say, right? And so this could be a panic that a country is doing that could be widely spread, right? And if China's hurting, what other countries are hurting too? Well, Asia, Africa, and European countries that surround that Gulf, right, of Herman or Herman, right? Saudi being included, Saudi Arabia was Africa, right? So by this hurting those countries worldwide, it's going to hurt the GDP of all the other countries, right? And mind you, it's a ripple effect with these things because even though the war can stop, an agreement can happen, there needs to be time for things to catch up. It's called supply and demand, right? So since supply is low and demand is high, prices are rising to slow down spending and consumption. So we have to jack the prices up and slow the market down. So here's my thought on that, right? Could this be the straw that breaks the camel back, which causes our market to go into the R word, right? That they love throwing around now is this recession, right? Possibly. Now, to go back on how I'm going to position myself for this recession, it reminds me of COVID, right? I don't know if we're allowed to say that on YouTube, but it reminds me of the C word, all right? Well, what happened? Well, in 2020, the same thing that China's doing, closing its exports of oil because of scarcity, they don't want to supply other countries with something that they deem as valuable right now. America did the same thing. We closed our imports and exports back in 2020 when the C happened, right? When that thing happened. And what did it do? It dropped our market dramatically, right? So right here on this graph, this is VOO. This is the stock that I'm in, which is it runs similar to S&P 500, which I think I should just go ahead and split S&P up. It's gonna be the same. They all run the same. Advanced charts. All right. So let's go to 2020, right? Right here is when we shut down when the C happened, right? And then when the C happened, what happened? Right? The market fell. Market fell. How much did the market fall? Well, let's look at it. It went from 336 all the way around to 220. That was over a 30% drop, right? And that happened within 1 month. Look at the dates. From 211 all the way to from 211 all the way from 320. So in 1 month, we lost 30% of the stock market in 1 month, right? So if you're paying attention, right, that's from 300 all the way to pretty much 200. Well, 330, 230, 220, right? That was over a 35% drop. So how am I positioning myself? Well, what came right after that? We had a market recovery that went higher than where the market fell off. So the market started right here, fell off from 330 down to 220, and then went to new highs of 470. So let's see, 330 times 35% equals 115. So roughly, if you would have got in the market right here, right, at its peak back in 2020, and then when the C happened, the market fell, and you would have loaded the boat and put more money in within that month frame. I know it wouldn't have been that easy because it was just a month. You would have got the 35% from here and another 70% just from here. But whoa, wait a minute, time out. There's more. What happened in 22, right? Well, in 22, remember, Trump and Biden had shut down America. Why? Because we wanted to get rid of the C, the spread of it. So once again, what happened? The market was down for roughly from January 22 all the way to October 23rd. So it was about that's a long time, right? So 22, that's the beginning of the next year. That's 12 months of downside and really a stagnation for about 10 months where the market's just moving sideways. It gave us a little flash and then came back down. So you had a year and 10 months of stagnation. But if you were loading the boat from here to here or from here to here and you're putting in 10, 5, or 20 to 30,000 a year, you would have had from 2020 all the way from 20 pretty much 24 because we're only like a few months from it. So you would have had 21, 22, 23, 24. You would have had 4 years, 3 to 4 years to put in. Let's say you did 10,000 a year. You did 10,000 a year. Well, you would have had $40,000 at beautiful prices. You would have had it from here, 10,000 here. You would have been buying peak here. You would have bought some lows here, some lows here, some lows here. And then guess what? After you had your 40 grand in there, you would have did what? You would have wept the benefits because the market would have went from 400 all the way to pretty much 700, which is what? Is that another 35% increase? Let's see. Oh, to me, that sounds like a 75% increase. Whoa. So if I would have had, I don't know, let's say I would have loaded the boat with 10,000 a year, $10,000 a year for those 4 years and had a 70% increase, I would have made 28,000 on top of my $40,000 just by having my money sitting a ETF, a broad market safe stock. So when people are asking me, well, I'm not putting my money, or people are making these suggestions, I'm not putting my money in the market because we're about to go through a recession. Guess what? Guess where I'm buying? Guess what? I can't wait. I can't wait for this. I can't wait for this because I'm gonna load the boat. I'm gonna load the boat. I'm gonna buy discounts. I'm gonna keep buying, and I'm not gonna stop. Right. So, uh, this is called DCA, dollar cost average. Keep buying. You don't gonna put a lump sum of money in. You just gotta pace yourself throughout the year and stay consistent to what you feel is good for you. Remember, you should be investing 5 years, 5 to 7 years forward. Right, investing for 5 to 7 years forward, and believing that the stocks that you're in is good stocks for 5 to 7 years. All right. So to the next thing, we're getting more to the portfolio side, right? The fear and greed index, right? We are at extreme fear, right? It is at a 10, right? Extreme fear in the market. That is insane. I think they said it hasn't been this low since COVID, the C era, right? So extreme fear a week ago was at 15. The previous close was at 17. Right now it's at 10. Right. When there's fear in the market, you're supposed to be doing what? As Kramer loves to say, buy, buy, buy. Right. When there's extreme greed in the market, you should be slowing down and just DCAing because that's when the market's going to be rising up. All right. Um, so coming into the market, what are we going to be looking forward towards? Right. We have the end of March approaching April. We have the job openings and labor turnover survey, right? So we already know unemployment's high right now, and I know I'm jumping around a little bit, but I need you guys to kind of keep up with me because I don't want to make this video long, right? So we talked about why the market is going down, possibly because of the oil, right, and the exports and imports and supply and demand, right? Then I kind of gave you an idea of what I'm going to do to position myself in this market uh, for the next 12 months, 24 months, right? So as of right now, coming into the week, kind of gets an idea of what's going on in the market, just for the week, right? Pretty much. Uh, we already know unemployment is up right now. A lot of people are losing their jobs. Why? Because the R word that's being thrown around, recession, and they're trying to see is, are we really getting into a recession area? Well, the 31st job opening and labor turnover will pretty much kind of give us an idea of what's going on. So job openings, where would the Fed loves for the job opening to be? They want it to where it's one person gets hired, three people probably gets fired, right? Why? Because that gives value to the dollar. As long as a person could keep his job knowing that, hey, it's going to be 3 times as hard for me to get a job. So let me keep this job. Um, Let me keep this job um, because I need a job for the dollar. So, and then they want to see, are jobs being created, right? Are there job openings, right? Because if job openings slow down, that's signs of recession. But if openings are up, then that's signs of that there's a market, a thriving market, and you can even possibly think about increasing interest rates to slow down job openings, right? The labor turnover, that's what I was talking about earlier with the 1 to 3 ratio. They want to keep the pressure on a dollar. So in order to keep pressure on a dollar, you want one you want you want one person to have you wanted it to be like a 1 to 3 ratio where it's like 1 to 3. If it was vice versa where hey three three people are getting hired and versus one person getting fired, well, uh, what that means for the companies, people aren't going to take jobs serious because they know, hey, I can leave this job, go somewhere else, and get paid. They're going to take more vacations. They're not going to be trying to um, expand within that job, and there's no long term commitments to the market or anything like that. So that's why it's a way to keep pressure on employees or hires is by keeping surveys of the job turnover and labor, and that would determine interest rates on whether it increases, stay the same, or lower. Because lower if the jobs are bad, then they have to lower the interest rates to help businesses be able to deploy more money into their businesses to hire or to expand their business to have the availability to hire. Sounds confusing. Google it. You'll get a better understanding from it than me rambling about it. All right. So what's going on for this week? Right. Nothing. Right. Uh, this is the weekly earnings coming up. Um, Nothing special to talk about. Not even Nike. Nike's a app I wouldn't touch with a 100-foot pole. Uh, no good earnings are coming up. No market movers. No Nvidia. No Tesla. No Google's. No Microsoft. No Magnificent Seven. No data. No big data centers. Cloud. AI. None of that. Right. So we don't have no company going to move the market when it comes to earnings. Right. Our biggest market mover will be at 10 a.m. on Tuesday. All right. So let's go to the portfolio and kind of give you an idea of what's going on in my portfolio. All right. Right now, my total account value is $6,928.54. My portfolio is down 7.20%. I'm down $534.79. My risk level is safe because I'm in a broad market with ETFs, right? Um, and let's look at my stocks. All right. Um, I'm gonna give you a quick rundown, and then I'm gonna go ahead and wrap up the video. Right, SMH, which is my semiconductor ETF. Right, it is 10% of my portfolio. I have invested in it $742.43. The average price of me purchasing it was at $401.21. And when the market had closed, the last price that it was post was $372.60. And I would love to start buying more at $372 to bring down my cross base at $401. I want to average out on this and get lower and lower. And if it drops more to like 350, 340, 330, I want to buy more of this at a lower price because SMH, I think technology is going to pull the market for all countries for the next 10, 15 years, right? Uh, so market value right now, of what it's worth in my portfolio is $689.49. I'm down $52.95, and I have 1.85045 shares of SMH. VXUS, that is my international stock ETF. International. I know international is getting beat up right now. All right. What I have invested in it is 507. I'm sorry, $750.09. It is 10% of my portfolio. Um, the last price when closed was $74.75, and my average cross base of my purchasing this was at $80.43. So I would love to keep buying this at this range, and if it goes down to $65, I want to buy more. Right? Um, the market value of what I of the market value of my portfolio is $697.09. I'm down $53 perfectly. and that is my Vanguard Total International Stock ETF. Vanguard S&P 500, which is like the broad market, 500 companies, 500 of the best companies in the market, quote unquote. What I have invested in it is $3,423.45. The average price of me purchasing it is $627.64. As you see right now, the last price when the market closed was $582.29. That's a lot. That's a little difference. $40 difference, right? And this is why I want to keep dollar cost averaging it and keep getting mine lower. I would love to be under $600 far as my crawling space of where I purchased this. And this is why I want to keep attacking this um, price point, especially for my S&P, because that's 50% of my portfolio. All right. So market value, all right. This is my total cost, and this is what the market value of if I wanted to X out of my position, this is what I would get. $3,176.10. I'm down $247.34. The difference from this and this. I have 5.4545 shares of S&P 500 ETF. All right. And S&P 500 Momentum ETF, right? SPMO. That's my more riskier stock. This is me. This is more of because I feel like I got a lot of time in the game to make money in the market for the next 5 to 10 years. So S&P is like one of my more riskier ETFs that I want to take. Um, it monitors the best 100 companies in the S&P, and every 6 months they tend to change the companies around. So what I have invested in it is $2,515.69. This is 30% of my portfolio. The last price when the market closed was at $110.02. Um, the market value of what it stands in my portfolio, the difference, I have $2,334.20. I'm down $181.49, and I have 21.21614 shares of SPMO. And once again, there's an $8 difference of the last close price, and I would love to be down. I would love to get SPMO under $100. Like if SPMO would fall below 100 because it's some momentum, I would love to grab this. I like in the 90s, 95, because this is a great company that will come back. And remind you, just because the price fall, guess what? Your shares don't fall unless you sell it. So I have 21 shares of this, right? Let's do the math, right? So um, let's say the price falls at to $80, right? Well, as of right now, I will be down 614. I will be it'll be 67.97, and the difference would be, let's see, the difference would be 25.15, 25.15. The difference would be $817 difference. That's how much I would be down. Huge from here, right? That's like a $700 difference add on to this negative if I get it, right? But let's say I kept adding on to this, right? And let's say throughout the year I end up getting 50 shares, right? And then let's say the price goes back to um, all-time highs, which would be like, let's say 130. Well, that's way more than what I have at my purchase power by having 50 shares. But let's say my average goes down and I get these 50 shares at a discount. Like, let's say I get these 50 shares at like, I don't know, um, $75. And this is how much I would have paid for it. Oops. So $75 would be the price of it in 50 shares. It would cost me 3,700. The uh, yeah, 50 plus the 21. Yeah, so it'd be 3,700 plus my 21. So I'll be up. If it would go back high, uh, I would double my momentum ETF plus what I already have in there because I'll be lowering my dollar cost average. So what you really, really, really want, what I'm trying to get is this, right? As I close up, because I don't want to confuse you. Um, Buy in the red. You know, you really want to buy in the red when the market's down. You don't want to deploy all your money in the market. You want a dollar cost average. Pay attention to the news. You know what I'm saying? They're pulling the rugs in the market, right? This is how big corporations make money, right? Big corporations make money when we all panic, when we all talk amongst each other, talk about the market, the fear in the market, while we don't want to participate in the game because we think it's manipulation. It could possibly be a manipulation, right? But all I'm saying is this: um, people get wealth in times like this. Let's say there's a neighborhood. Let's say, here's a best example. When the C happened, right? 2020, guess what? The market went down and a lot of homes, what happened? They devalued quick. People were panic selling their homes, right? Because they felt like they was losing value. But what happened? A lot of corporations came in and brought them. Then what happened? The market came back up and it doubled up. And then all the houses that were at 200, that were 200,000 are now 400,000. But guess who really made bank on that? Big corporations. Why? Because they love to buy when the market's down. And I'm going to leave you at that because I'm not going to confuse you because I could talk all day about this. So, um, subscribe if you want to hear more. Appreciate you. Week 13. We will be back week 14. There's things I want to start implementing in my portfolio. Might be coming next month in April or the following month. If you like this video, hit that like button. If you have any suggestions or you want to give your opinion or thoughts on the things I said, or you want to go ahead and tell me what you think about the market, get down in that comment section. Other than that, peace.